Saudi Arabia just made its steepest price cut on record in data going back to 2003. In July of 2026, the kingdom cut the price of its Arab light crude to Asia by $1.50 a barrel below the regional benchmark. That is the largest monthly cut Reuters has on file for that pricing measure in over 2 decades of data. It did not happen in isolation. Days earlier, OPEC, the Organization of the Petroleum Exporting Countries, and its allies approved another production increase. It was the 5th straight month of rising output, adding 188,000 barrels a day into an already crowded market. Brent crude has settled back near $72 a barrel. WTI, the American benchmark, sits around $68 to $69. Both are close to where they stood before a war shut down the Strait of Hormuz for weeks this spring. On paper, that looks like stability returning. Underneath it, something else is happening. Saudi Arabia is not simply replacing wartime barrels that went missing. It is discounting its flagship crude at a rate traders have not seen in 23 years of record-keeping at the exact moment its own production is climbing for a 5th straight month. Robert Yager, who directs energy futures trading at Mizuho, put it plainly, it is increasingly looking like the Gulf producers are gearing up for a price war. That phrase has a specific, well-documented precedent. The last time Saudi Arabia did this, oil did not settle at $72. It went to $8. In the winter of 1985 into 1986, Saudi Arabia abandoned a role it had played for years, the OPEC member that cut its own output to keep prices high while everyone else pumped. It walked away from that role on purpose, and it did so loudly. Oil prices fell from around $27 or $28 a barrel to under $10 in a matter of months. The man who engineered that collapse was Saudi Arabia's oil minister, Sheikh Ahmed Zaki Yamani, who had held the job for 23 years. He did it with a pricing mechanism called netback pricing. It worked exactly as intended. It also cost him his job. To understand 1985, start with 1980. Saudi Arabia was pumping over 10 million barrels a day, and OPEC as a whole was near its historic peak. Then the market turned. Non-OPEC producers smelled opportunity in the high prices the 1979 Iranian Revolution had created, and they built out entire new provinces to chase it. The North Sea came online. Mexico expanded. Alaska's Prudhoe Bay ramped up. The Soviet Union kept pumping regardless of price. American independent drillers, men like Texas oilman T. Boone Pickens, went after every barrel they could find on shore. New entrants, China and Angola among them, added still more supply. Demand was shrinking too, as the industrialized world responded to the previous decade's price shocks with conservation and efficiency. Somebody had to absorb the gap between too much oil and not enough buyers. Saudi Arabia did. By August of 1985, Saudi output had fallen to somewhere near 2.3 million barrels a day. That is less than a quarter of what it had been pumping 5 years earlier. OPEC's total output fell by roughly half over the same stretch, from 31 million barrels a day in 1979 to 15.5 million by 1985. According to oil analyst Ian Seymour's contemporaneous accounting, in 1983, Yamani had already persuaded most of OPEC to formally cut its official price for the first time in the organization's history. It did not work. Non-OPEC barrels kept coming, and OPEC's market share kept shrinking no matter how much Saudi Arabia sacrificed. By the autumn of 1985, Yamani had had enough. He announced that Saudi Arabia would abandon the swing producer role entirely. Instead of cutting output to protect price, Saudi Arabia would protect its market share, whatever that did to price. The tool was netback pricing. In plain terms, it guaranteed refiners a fixed profit margin on Saudi crude, no matter what the finished products, gasoline, diesel, jet fuel actually sold for downstream. Saudi Arabia removed the floor from underneath its own oil. Refiners could buy as much Saudi crude as they wanted, confident they would make money regardless of where the price landed. There was effectively no limit to how far the price could fall. It fell fast. Prices near $27 or $28 a barrel in December of 1985 were near $10 by the following summer. Some accounts, cited in a 2014 Bloomberg retrospective, describe a 4-month plunge of 67%. By figures from the Energy Information Administration, OPEC's average price bottomed at $9.85 a barrel in July of 1986. OPEC's total output surged the other direction, climbing from a low of 14.1 million barrels a day in June of 1985 to 21.8 million barrels a day by August of 1986. The strategy worked in the narrow sense that it was designed to work. It also came at a real cost. Saudi imports fell 28% in 1985 alone. The kingdom's foreign financial reserves had already declined by more than $50 billion over the preceding 3 years. Drained by budget deficits and the need to keep supporting its currency, the government had built its 1986 budget around an assumed price of $28 a barrel. Actual revenue came in so far below that assumption that the budget itself was delayed 5 months, and subsidies on wheat, water, and electricity were cut. Across all of OPEC, collective oil revenue fell by roughly $50 billion between 1985 and 1986. Columnist William Safire, writing at the time, speculated that the real target of the flood was Iran, suggesting the strategy was meant to produce and produce until low prices bankrupted Tehran. That was Safire's interpretation, not a confirmed Saudi motive, but it shows how the move was read across the region. By August of 1986, OPEC's ministers met in Geneva to try to put the genie back in the bottle. 12 of the organization's 13 members reached an interim deal, reverting to something close to the old 1984 quota structure and capping total output near 17 million barrels a day. Iraq refused to sign. Prices recovered modestly anyway, climbing to around $13 or $14 a barrel by mid-October. That same October, King Fahd fired Yamani after 25 years as oil minister. By some accounts, Yamani first heard the news while playing cards in France, watching it break on television before anyone from Riyadh had called him directly. He learned of his own firing from a television screen. In December of 1986, OPEC abandoned netback pricing altogether and moved to a new fixed official pricing system targeting around $18 a barrel. Through 1987, prices held roughly there. In nominal terms, OPEC's revenue rebounded to about $90 billion, a 25% jump from the crash year. But in real terms, adjusted for a weak dollar, it was still roughly half of what the group had earned in 1985. Oil stayed broadly range-bound, mostly between $11 and $25 a barrel for close to 14 years, until the commodity boom of the early 2000s finally broke the pattern. Saudi Arabia took the lesson to heart in a way that shaped decades of policy afterward, building far larger financial reserves as a buffer against ever being that exposed again. Gross domestic savings as a share of its economy climbed from around 10% in the mid-1980s to roughly 44% by 2013. What is happening in 2025 and 2026 follows a strikingly similar playbook, and the people trading oil for a living recognize it. Once again, Saudi Arabia had been absorbing the burden of restraint while other producers did not carry their share of it. Since 2022, the OPEC Plus group, OPEC members plus allies like Russia, had agreed to voluntary cuts totaling 2.2 million barrels a day across 8 countries. Saudi Arabia held up its end, others did not. Analysts pointed to Iraq, Kazakhstan, and Russia as the chief offenders, with overproduction across the group estimated at around 1.2 million barrels a day above target in the first quarter of 2025 alone. Kazakhstan has a built-in excuse. Its giant Tengiz field is run by Chevron under a production sharing agreement that predates the country's OPEC Plus membership, which limits how much Kazakhstan's own government can actually restrain it, even when it wants to. Starting in April of 2025, Saudi Arabia stopped absorbing the shortfall and started reversing its own cuts instead, month after month. By June, the group had unwound nearly half of the barrels it had promised to keep off the market. The mechanism is the same as 1985. What is different matters just as much. The 1985 collapse unfolded inside a relatively stable market, a glut that built up gradually over 5 years of steady non-OPEC growth. 2025 and 2026 unfolded inside chaos. In February of 2026, war between the United States, Israel, and Iran shut down large stretches of the Strait of Hormuz, a choke point that normally carries around 20 million barrels of oil a day. Global supply cratered by 10 million barrels a day in a single month, the largest disruption the International Energy Agency has ever recorded. Much of what looks like a Saudi supply flood right now is not a pure market share offensive the way it was in 1985. It is partly the market refilling barrels the war took out. As Rystad Energy's Jorge Leon put it, an OPEC Plus production increase means very little while the Strait of Hormuz remains closed. When the Strait of Hormuz reopens, the market could move very quickly from fear of shortage to fear of surplus. There is also a structural fracture in 2026 with no real equivalent in 1985. At the end of April, the United Arab Emirates announced it was leaving OPEC entirely, ending 59 years of membership, effective the 1st of May. The UAE had built its production capacity up 40% over 6 years to 4.85 million barrels a day, while OPEC capped its quota at 3.4 million, 30% below what it was capable of pumping. Analyst Andy Lippo summed up the frustration driving departures like that one. Countries that are tired of seeing their fellow OPEC and OPEC Plus members consistently cheat on their quotas are candidates to leave these groups. In the 1980s, OPEC lost smaller members over the decades, but never a top-tier Gulf producer with major spare capacity walking out in the middle of a price dispute. If the pattern holds, Saudi Arabia is not bluffing, and it is not going to blink first. It has the lowest production costs and the largest spare capacity of any producer in the group, the same structural advantage that let it outlast everyone in 1986. It also suggests paying for the weaker members of the group first, long before it forces Saudi Arabia itself to change course. Whether that pain arrives as a crash or a slower grind is the part 1985 cannot answer. The comparison has to be handled carefully, because the two crashes are not the same size. 1985 was a genuine collapse, prices falling from around $27 or $28 a barrel to single digits, a decline of somewhere between 58 and 67% depending on the benchmark used. Nothing close to that has happened yet in 2025 and 2026. Brent spiked above $100 during the Hormuz War this spring and has since come back down to around $72. That is a return toward pre-crisis levels, not a crash to historic lows. Calling this a repeat of the single-digit collapse would be inaccurate, and nothing in the current data supports it. The trigger is different, too. 1985 grew out of a decade of structural oversupply building slowly and predictably. 2026 is entangled with an acute war and a shut choke point, a kind of shock the 1985 story never had to deal with. 1985 has a documented ending, the Geneva deal, Yemeni's firing, prices settling near $18. 2026 does not have that ending yet, and as of this recording, in July of 2026, nobody honestly knows what it will be. Where things actually stand right now. Saudi Arabia has cut its official price to Asia by the steepest margin on record. And OPEC Plus has approved 5 straight months of higher output through August. The UAE is pumping outside the quota system entirely, pushing toward record output near 3.7 to 3.9 million barrels a day as of June. Brent sits around $72, WTI around 68 or 69. Numbers that would have sounded calm a year ago and now sound almost suspiciously calm given everything underneath them. What remains unresolved is whether the discounting Saudi Arabia is doing right now is a temporary correction as Hormuz traffic normalizes, or the opening stage of something closer to 1985. Analysts are already naming the next candidates to watch. Lippo has flagged Nigeria and Venezuela as producers that could follow the UAE's path out of the quota system if the squeeze continues. The 1985 precedent does not promise a crash to $10 a barrel, and nothing in the current numbers points there. What it does promise, if the pattern holds at all, is that the producers with the least room to absorb lower prices will feel this first, and that Saudi Arabia, with the deepest reserves and the cheapest barrels in the business, same as it had 40 years ago, is built to outlast almost everyone else at the table. That was true in 1986. It fired an oil minister, drained a treasury, and reshaped how an entire kingdom managed its money for the next 3 decades. Whether it reshapes anything, this time is still being written, barrel by barrel, price cut by price cut, 1 month at a time. For now, watch the official selling prices Saudi Arabia sets each month. That number, more than any headline barrel count, is where the real signal is consistently shown up first. Watch Iraq and Kazakhstan's actual output against their quotas, not their promises about it. And watch whether Nigeria or Venezuela start making the same kind of exit noises the UAE made in April. 40 years ago, those signals arrived slowly, over years, and the world barely noticed until the price had already fallen off a cliff. This time, thanks to real-time shipping data and monthly pricing disclosures, everyone gets to watch it happen in something close to real time, which does not mean anyone can stop it. It just means nobody this time gets to say they didn't see it coming.